So, in this presentation, I've proposed a few little questions and some answers. Now, I don't know whether you want me to go through them now, or whether you want to propose them yourself. No? You want to go through these now? Yeah? Okay. So, banks could not lend out money. Yes, they could via the second door in my proposal. Yeah? When you tick the box and say, yes, I want to earn some interest. I know it's going to be saved. I know I'm saving my money. I know it's being lent out to somebody else for the time period that I agree. Why will there not be less credit, which will have the same effects as the deflation of the Great Depression? Well, note, actually, I'll come back to that answer in a minute. Because one of you, I heard the question to Steve Baker, you were talking about a deflation of the money supply. Under this system, there's no deflation, because you fix the money supply. There can never be a money deflation. Stop. We have only money that is physical cash. Now, okay, you can burn it, you destroy it, and then you'll have a deflation of the available resources, but presumably it could just be replaced. Anyway, the second door will have as much savings in it that people will wish to lend. Savings are the future investment amounts that will provide goods to consume in the future. So we are far more likely to match our current needs and our future needs. If we adapted the mutual funds approach suggested by Kotlikoff, then the system would be indistinguishable from today, save as one institution could not bring only itself down. Money supply would not be able to grow, therefore would spin off into a massive deflation like the Great Depression. Well, I've just answered why money wouldn't, collapse in a deflation. Money also wouldn't grow, yeah? And some people have a conceptual problem with this, because they think money always needs to be growing because there's more people, there's more transactions going on, and so on and so forth. But you only need any sum or amount of money will actually do to facilitate transactions in the economy, because what happens is if you have a fixed money supply, you allow the money unit to adjust up or down the purchasing power, rather than requiring more units to transact more things. So it's a purchasing power adjustment that will then take place according to your productivity gains. I.e., you might actually see permanently falling prices, which is a good thing. We all like to pay less for our goods and services, don't we? We love paying less for our computers, for our iPhones, for our this, for our that, or for the other. The aim of me as a capitalist, an entrepreneur, is only ever to deliver up to my customers better priced, better quality goods and services. And yet I fail every day because my prices only ever go up. And they only ever go up because the money unit is being debased all the time. Would not the artificial creation of bank credit, even if it does cause boom and bust like the dot-com boom and bust, be worthwhile as some of the things created in it, new companies, new companies come into existence. I'm often said, credit creation is wonderful. Okay, we know the artificial creation of it will create boom, but in those booms, great gems are born, like Google and eBay and so on and so forth. And obviously there's a lot of destruction, as we know. Now, I think great things are always going to be born, is my personal view. And we just have a lot less of the bad things causing destruction. So, I think you get the idea there of what I'm trying to do is get banking back to a very simple format. The save of the banker, lending, nice and simple, end of story. Now, my end goal in all of this post-reform is to fully embed money back into the power of the people. Having money in the hands of the politicians has been thoroughly a disastrous episode for us. Having money controlled by the state has only seen our money be massively devalued. And this is what differentiates us, I think, from the positive money movement, because you want the money to be controlled by the state. And I think that's the greatest disaster for humanity to have the money controlled by the state. You may all be aware, you may not be aware. This was done in June. An example of if we have money rooted back in gold or some such other commodity that provided the same characteristics of gold, we wouldn't have the debasement and the thievery of our purchasing power that we've had over the last 100 years. 100 years ago, 1 ounce of gold was worth £776. You take the gold price now, I think that will give you, well, in June it would have given you £191 of purchasing power, which means that our currency has been debased by over 99%. I think it's nearly 100% since the end of the First World War. So if you root money back into a commodity, now I don't know what commodity format would be acceptable to the public, and I think you have to go through an entrepreneurial discovery process of trial and error, who knows what it will be. But with a commodity that you cannot mint up or print overnight, you cannot have money debasement, and that's the most critical thing for ensuring that the people get back into control of their purchasing power. Now, Steve, did you use it? You use that one. Okay, so they understand that one. So anyway, thank you very much. That's my